Welcome back to Kuwaiti Dinar Analysts, the channel where we explain global economics, currencies, and long-term power shifts calmly, clearly, and without hype. If you're trying to understand how international trade relationships are evolving and why certain agreements attract attention from global markets, you're in the right place. Today's discussion is not about politics or personalities. It's about economic structure, trade alignment, and long-term trends. A recent economic cooperation agreement between Canada and China may appear routine at first glance, but when viewed through a global economic lens, it reflects broader changes currently shaping international trade. Let's break it down. Canada is a long-standing trading partner of the United States. China is one of the world's largest trading economies. When countries with strong existing partnerships expand cooperation elsewhere, financial markets naturally take interest. The questions analysts ask are simple: why now? What economic conditions influence this decision? And what does it suggest about global trade strategy? This agreement is not just about trade volume. It reflects how countries are managing economic exposure in an increasingly interconnected world. This development did not occur in isolation. Across global markets, many countries are expanding their range of trade partners, reducing concentration risk and improving supply chain flexibility. Canada, like many economies, aims to maintain stable exports, secure reliable demand, and preserve its strategic flexibility. On the other side, China offers large consumer and industrial markets, long-term trade frameworks, and established logistics networks. This approach is not directed against any single country. It is a common and rational strategy known as economic diversification, a way to build resilience. From a U.S. economic perspective, these global adjustments are closely monitored. Why? Because U.S. economic influence has traditionally been supported by strong trade alignment with partners, widespread use of the U.S. dollar, and coordinated economic frameworks. As global trade relationships become more diversified, economic influence naturally becomes more distributed. Traditional leverage tools become less central, and the global system becomes more balanced. This isn't about one single agreement. It's about how the very structure of global trade is evolving over time. An often overlooked aspect of trade agreements is currency usage. When countries expand their trade relationships, the currencies used for transactions tend to diversify and payment systems broaden. This makes financial exposure more balanced across the board. Increased trade with China, for example, often involves greater use of the yuan, which in turn reduces reliance on a single settlement currency. No country announces major currency changes overnight. Instead, these adjustments happen gradually and quietly. Markets tend to notice these subtle shifts long before they make headlines. It's important to clarify one thing. These economic developments predate any single administration, continue regardless of leadership changes, and reflect long-term strategic planning. Global economic competition is structural, not emotional. Any major economy would evaluate these trends carefully because they influence trade stability, currency systems, and long-term growth prospects for everyone involved. So, agreements like this contribute to a broader transition toward more regional trade networks, reduced dependence on single systems, increased currency diversity, and greater competition for economic influence. The global economy is gradually moving from a highly centralized model toward a more multipolar structure. This transition can bring market adjustments, strategic repositioning, and even periods of uncertainty. But the key point is, it is already underway. Financial markets do not react emotionally. They respond to patterns and probabilities. When markets observe trade diversification, currency flexibility, and shifting economic alignments, they begin to price in long-term structural change, emerging centers of influence, and new investment dynamics. These factors go on to influence currency valuations, commodity pricing, capital flows, and long-term investment decisions around the world. So what does the Canada-China deal really represent? It's not a breakdown of existing relationships or some kind of political statement. It simply reflects a broader reality. Countries are preparing for an economic environment where no single system dominates entirely. That shift is what policymakers are observing. That is what markets are evaluating. And that is what defines the next phase of global trade. If this analysis helped clarify how global trade trends are evolving, support the channel by liking the video and subscribing to Kuwaiti Dinar Analysts. Share your perspective in the comments. Do you think global trade will continue moving toward a more balanced structure? Thank you for watching. Stay informed, and I'll see you in the next analysis.